Bell rolls is the reporter thrown into the secretive world of the Forex supermodel, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager. Hello, I'm Professor Code, and this is the Forex additional video for how to trade risk off in Forex. And today has been such a great day for us that we thought we'd pass it on. We've been trading the USD JPY, dollar yen on the down, and it's a textbook example of what you can do if you get your act together and basically the markets are in sync. So we thought it would be useful to pass this on, because I know there's a lot of people interested in Forex, and if you're not, maybe it's time to get interested. So basically what we're looking at is Friday the 17th of the 3rd, 23 then, USD JPY. If you look at the 10-minute charts, the advantage of 10-minute charts on day trading are that you tend to see pretty much the day starts about there, and you get a full view of so that would be the 17th of the 3rd. So the day sort of starts nicely on the chart, and you can scroll it in and get a good view of what's going on. Let's grab this then. So what did we do then? Well, we're looking at this this dollar yen, and as we said, it's a Friday, so there's potential for a sell-off on Friday, and basically you're looking at the transmissions in the JPY, USD JPY. So transmissions sort of backing up this, and you're also looking at this sort of you've got a very basic sort of downward trend line here. So it's a downtrend up, and this is what was it? Where are we? This is about 1040. Now you got this sort of chunking downtrend in the US JPY, and it's a rough and ready trend line. You can literally just hold a ruler up against your screen and see that if you want to look back at it, and then it creates this low, and then it breaks out of this the trend line on the up, and that's your first sort of signal, if you like. And then you get this situation where it peaks out here, it comes off, and then you get this lower peak here as well, and you can just draw a very Mickey Mouse trend line across 2 points there, which is not really a proper trend line anyway. Now this is the key point there. So you got a break in this so-called architecture of this trend line, and then you're starting to see weakness on the up here. If you look at the graph, the chart. Now, just looking at the key transmissions, you want to be looking at the US 10-year. You want to be looking at the US dollar index, so DXY, and you want to be looking at gold initially. Those three are key. Now, gold's normally got an inverse relationship. So if we're looking to sell the dollar yen, then we want a weaker dollar and a stronger yen. You normally get that in a risk-off situation. So, and if you get a weaker dollar, you tend to get a rise in US 10-year price, because that means the yields are falling. So this is price. So if you get that graph up and have a look at that chart, you're getting a drop in the dollar, and all this is at around 1040. Getting a drop in the dollar index, and gold is reinforcing that. You're getting a rise in gold with its inverse relationship there, right, so that's the first phase. And then you're looking at equities, which is like risk assets. So you've got Wall Street, S&P and the tech. Now the tech's chopped, but Wall Street and the S&P starting to sell off around 1040, and that gives us a little bit more encouragement as to what's going on. So you've got a risk off equity flow exits out of equities. The tech is chopping, and the tech index is slightly different anyway. So you've got more broader indexes here, the S&P 500 and Wall Street. And then you've got oil just as an addition. So you've got oil, US crude, and in this case oil started selling off at around 1040 as well, a bit later, suggesting that there was a general negativity. You know, you can get oil going up if it's geopolitical risk. Depends what's going on. But so oil is not necessarily one to be fully okay with, but in that case it sort of reinforced our view. We'll just stop that there just to edit the tape. So right, we're back. That was just for the editing purposes, just the way it goes. So right, so what have we got then? We've got this situation where we've got all the transmissions starting to reinforce risk off, a fall in US JPY, and we've got this architecture. We've had this this pump through the trend line, and then we've had this secondary move back down towards the trend with this weakening buying of this breakout from the trend line, if you like. So now initially the safest part of the trade is here. So if you're shorting down to this trend line, because quite often you'll get a bounce there, but in this case we've got a continuation. So you need to be prepared to get out here on the initial trade. Otherwise you can get bounced, and you know, if we weren't having full risk off, which we've got today, you're quite likely to have seen a bounce up, and that's a good position to actually buy from under normal circumstances. But today, so the smart thing to do would be to ride those pips down. It was volatility on the 10-minute was about the chart was in 20s. So this is in 20s. So 20, 40, 60, etc. And that's about the optimum for not getting burnt in terms of volatility. So you chunk that down. It was about 40 points between the entry and the sort of low there. So arguably you could say you could pinch about 30 of those, and then you could take the trade out there and then see, because as I said, it's quite likely to bounce there, but because the bottom was falling out of the market effectively, you were getting this like US 10-year dollar index and gold all reinforcing the risk off move, and then you could rejoin the party on the downside here and really make hay. And the market's moved down over 100 points basically, and we've managed to capture a good proportion of that. But that's irrelevant. But regardless of that, that's the sort of scenario. That's a very nice setup on the day. You've had your transmissions reinforcing your trade, and as I say, the main problem with it is this potential for this bounce at this point, and you need to be very careful generally about that, because that's a position that a lot of people tend to buy back in, but because everything was going south, that didn't happen. So anyway, that is a very good textbook example of how to trade risk off in Forex, really. And you've got the weekend and to review the charts, and hopefully you get some benefit out of that. you know, the that's the old school transmissions really of risk off in terms of a stronger JPY, a weaker USD, and all the run out of risk assets and rising US 10-year price, etc., rising gold. So that's where we are. Hope that was useful. We've had a very good end to the week there, and we just thought we'd pass that on. You can review it at your leisure, and hopefully have a go when that situation happens again. So anyway, thanks for watching, thanks for subscribing, and goodbye.